much like I did in the strategy panel, I'm going to do the exact same thing. Finance. I mean, this is the broadly speaking the finance panel, but it really is, as I see it, as I've experienced it, it's about financial management on the one hand, and funding on the other. And one is a very operational activity around finance, and the other is very much around strategy, funding, investors. And we've got a great panel here today of people that have touched, professionals that have touched both sides of those, some more deeply than others. But just like I did the last time, I'm just going to let them introduce themselves, and where they've been, kind of what they've done, and then what, from their perspectives, are what could be one, maybe two critical things about either the financial management side of things or the funding side or both. So I'm going to hand it over to Oscar Garcia first.
Thank you, John. Good morning, Oscar Garcia, Chairman and CEO, Interflight Global Corporation. We are strategic management advisors and investors for the air and space industries, and we have a very strong focus on space mobility and transportation, which means all the contexts and all the infrastructures that support whichever activities are done in space. And depending on who you ask these days, whether it's McKinsey or Deloitte, or the space economy is starting to push $1 trillion, and pointing at $1.5 trillion, $1.8 trillion, I believe, by 2040, and who knows from there on. All the speculations are open. But on that volume of economy, the transportation, the mobility element of it is sometimes hidden in plain sight. But like any other revolution in the human history, whether it was shipping or carts with horses, railroads, automobiles, aviation, we are those tools, transportation and mobility, have been the core, the infrastructure that has allowed for the economies to exist, whether globally or in different verticals. So we're very focused on the contextual transportation side of the industry. We are also private equity investors. About 2/3 of our clients, we are invested in them with our own money or money that we raise. So when we give strategic advice, or we insert C-suite or vice president level executives, we have skin in the game, and I think that's very important. So from the totality of the industry, the transportation element is probably 20 to 25%. So out of $1 trillion in activities, say by the end of the decade, $250 billion will be the tools and the elements we need to get there, to get back and to do things, whether in orbit, cislunar, or one of the niches that I love to share with audiences like yourselves, which is another $1 trillion industry hiding also in plain sight. And in a few hours we'll see SpaceX performing one demonstration of what I'm talking about. What I'm talking about is the use of space for mobility on Earth, meaning you launch a space vehicle and you go across the world to an antipodal point in an hour. We are very, very focused on that segment. IFT-7 from SpaceX will fly tomorrow, hopefully. That'll be the third time that a human vehicle has crossed the world in 1 hour. Last flight, it carried a banana. The first payload in history to cross the world in an hour. And Chiquita Bananas, if any of you know that company.
Good advertising opportunity.
Reached out to us from Ecuador and called us and said, "What happened there? What was that? You moved the banana across the world in 60 minutes? I said, "Yeah." So the rest is starting to roll. So that industry, we've studied it with different partners, Deloitte, SAIC, Bryce Technologies. It's a $1 trillion plus industry, moving goods and people across Earth using a space trajectory. So we're very much involved in that. We are also in ISRO and energy, cislunar and lunar economy. We're involved with spaceports and their adjacencies with airports. Half of our practice is aviation, air transportation, and the other half is space transportation. And we are known to be kind of the group that understands the in-between air and space transportation. We are a small firm based in Miami, Florida. We have 10 people in that location, 2 here in Boulder, and thanks, John, for inviting me. I was spending some time here in Boulder, and then we have an office in Luxembourg from where we source private equity, and we also have a transatlantic practice where we bring European companies to the United States and American companies to the EU, and now to the UK as well. So that's what we do. A couple of points that I like to bring up to kick off the dialogue is if I had to, and I talk to a lot of small and medium-sized companies, shareholders, investors, and executives, the biggest piece of advice I can give is don't run out of money. And what does that mean? Well, we will talk about this a little bit later, but as much as engineering is important, financial engineering is also very, very important. And when I bring that comment and that advice to the boards or to the clients, they say, what do you mean financial engineering? What's that? So across the panel and through this session, I'll share with you some thoughts about what does financial engineering, what is a chief financial engineering officer, and how does that impact the resiliency of a space company. So I'll share with you some thoughts, but that's about myself. And by the way, my company name is Interflight Global Corporation, but I'm going to trademark this one too, just in case.
All right, Steve?
Sure. So I'm Steve Bartz. I'm a shareholder in the Dallas office of Greenberg Traurig. I basically help my clients make money by buying and selling businesses and assets, and also through joint ventures. And so part of the way that I do that is through mergers, acquisitions, dispositions, private placements of securities, JVs. Used to do some fund formation activity. I like to pass that off to my colleagues now. It's a little bit too broad. M&A and private placements is sort of broad enough. But I really focus on a process in connection with those types of activities. But in connection with the process, I think it's also important to be fairly deep in understanding the issues that clients deal with in various industries. And so to some degree to that end, having gotten a taste for dealing with clients who are in the air and space industry several years back, and then really seeing that start to pick up, I got incredibly interested in the space industry. And so I'm actually working on my master's in laws right now, my LLM, while maintaining a full practice and raising 3 kids and everything else. So it's a full-time load, but I love learning, and I really enjoy a lot of the technical aspects of the industry. And so as a result, I think when you're looking at practitioners, it's important to know who it is that you're looking for in terms of advisors and outside advisors. In part because, like, for example, in the prior panels, we've already heard from a lot of lawyers today, when you're dealing with folks in the regulatory space, it is incredibly important to have folks that are a mile deep in the ins and outs of the various agencies and the processes that you have to go through in connection with those to be able to navigate those environments and to do so successfully and strategically. But then there are other areas where CFOs, outside consultants, accounting firms, law firms for sure, outside of the regulatory area, where it is important to have folks who are able to identify issues within their fields to be able to help you as a business strategically navigate those as well. And so that is part of what I do in connection with my clients, whether it's in the context of a specific deal, or it's in the context of sort of acting as like outside corporate counsel for some of them, or working through a cap table or a joint venture and trying to figure out strategically what it is that they're looking to do, and then working through the tactics and then getting into the real nitty-gritty. And so I can go into some depth of what that looks like on the legal side, but obviously I think it applies broadly to all advisors. And so one of the things that I think perhaps we might discuss in connection with the panel is the importance of working with advisors at an early stage and finding people that do have that strategic thinking, and coupled with deep expertise or very good, maybe not a mile deep, but maybe a half mile deep in a variety of different areas, so that those folks can help work with you strategically to identify what it is that you're looking to accomplish, and then identify other individuals to bring into the process where you can go a mile or 5 miles deep in a given area and efficiently work through those things. What I see oftentimes, and it happens in a variety of different contexts, is that folks will delay engaging outside advisors. It could be something as like putting off getting a quality of earnings report when thinking about doing an M&A transaction. It doesn't matter who or what type of advisor you're talking about. When you delay reaching out to those folks, it can often handicap whatever it is you're looking to accomplish, and it can sometimes jeopardize the objective. So I think that's something that we might want to dive into a bit in some very specific contexts.
Great.
All right, Sam.
Yep, I'm Sam Francis. I'm the founder of Crux CFO Advisors. We provide CFO and investment banking services to lower middle market companies in the space industry. I consider myself a newbie in the space industry. I got started 6 years ago when I became the CFO of Blue Canyon Technologies. Some of you might be familiar with it. It was a Colorado-based company. It's still here. And I was there for the 2 years up to and through the sale to Raytheon. So it's been a real privilege to be in the space industry. I think kind of dovetailing on what was discussed in the strategy session, and I really like what you said, Oscar, is we consider ourselves differentiated in the market because we are strategic leaders, right? Often we have to demystify what a CFO does for kind of a first-time CEO and a first-time C-level team. I think there's not always a clear understanding in kind of the difference between a CFO and an accountant, or a CFO and someone that builds financial models. We use those tools, but that's really what we try to focus on, is the leadership and strategic aspect of the office of the CFO. And companies hire us typically when they're getting ready for a transaction. So we've recently kind of moved back down into early stage, where we found so much demand in the space industry to help kind of shepherd companies from early stage all the way through an exit. And I wanted to also say, I really like what you said about, often as professional service advisors, not just in the CFO world, we're brought in at the last minute to clean up a mess, right? So,
Which would be more expensive than planning them.
well, more expensive and not as good of an outcome typically. But that is very common, that not just in the space industry, where we find, again, kind of first-time founders, first-time C-level folks that are engineers and scientists first, kind of waiting, right? So we do have kind of what we've been known as the CFO SWAT team. We've also been known as, if you remember Pulp Fiction, the wolf who went to clean the mess up. We do a lot of that, but ideally we like to get it in early, right? And we have, as law firms now do, kind of flexible models of, hey, we know you may be capital constrained, but we have kind of like, here's the bare minimum you should do now. And we have offerings that are structured around kind of the stage and financial wherewithal of the company. I'd like to focus on, actually, let me ask, so I know Becky's a finance professional. I see my friend and great CFO Carter here. Is there any other finance pros in the room? All right, so we got two.
You're on your way.
2.5 finance pros. The reason I ask is I want to tailor what I say to the audience and not be super dry, even though finance can be a dry topic. But I really want to talk about two things. One is understanding your customers, right, and your go-to-market strategy. Because what's unique in this industry, or at least is important in this industry compared to the software industry, where I came from, is the working capital constraints around those 3 different segmentations of the market: national security, commercial, and civil, right? Very different capital requirements to service those customer segments. And number 2, I'd like to talk about kind of short-term, long-term capital formation strategy. I find a lot of first-time founders are reluctant to say abruptly and directly, hey, I want to sell this business for $200 million in 5 years and I want to own 20% of it. It's okay to look at that. Right? And I think you just see a lot of kind of discussions around, well, I'm building a sustainable company. Well, a sustainable company ultimately will have some liquidity for the shareholders. So what I call the capital formation dance varies over time, but I think we're going to talk a little bit about that today.
Yep, we are.
Thanks.
Thanks, Sam. The one thing about this team that we pulled together is that they're all hands-on or hands-in, and I differentiate that between hands-on. These are leaders that have kind of lived it, breathed it, done it, and that hands-in mentality is what's going to make this kind of panel really good for, I think, this audience of sort of mid-market and small market companies. Kind of where I started this, which is financial management, and I'm going to piggyback off what you just finished with, Sam. There's the financial management side of these companies that obviously supports funding organically or otherwise. from a day-to-day operating financial management point of view, you just touched on sort of strategy, customer segmentation. Like, what are the things that you look for? And I'll start with Sam first. And everybody's got different perspectives and different experiences. But what do you look for in your, as a CFO, or in your management teams, or in the teams of these companies, that is going to help them realize financial management athleticism and precision and success?
Sure. So often, again, when we come in as a first-time CFO, we'll do some historical trend analysis. So I'm now speaking about companies that are in commercial production, be that services or products. And what you'll often see is massive swings in working capital. And if you don't know exactly what working capital is, think your current assets less your current liabilities, right? So cash, accounts receivable, inventory, deferred revenue, accounts payable. And the reason that we start there is it always seems to be an aha moment when we say, hey, let's look back, 18 months, 2 years, and look at these fluctuations in working capital. Sometimes it's because you started a new program, you took on a new commercial customer that doesn't give you a big prepayment like the government will, and you can see very quickly the dramatic impact that has on working capital and ultimately cash. Right? But typically we don't see that acumen is already inside the company, right? So again, it's an aha moment. And then we can use those historical metrics to try to optimize the financial performance. The great thing about working with science and engineers is most of them are good with math, right?
Right.
That's
Right. Exactly. Ones and zeros.
right. So I've always been, we're taking a company right now it's an engineering services company, and we're seeing a lot of this engineering services companies converting to product companies. And most of these founders come from primes or from the government. And I've always been pleased to see how quickly they are able to learn financial concepts. So yeah, being good at math helps.
That does. Just to continue on just for a second, Sam, and then KPIs. I mean, in that process of bolstering working capital, do you have sort of KPIs that you focus on and insist upon companies focusing on?
Yeah, and I had a quick chat with Mac earlier, who I want to get to know. What's different about the space industry, and I come from the software industry, is in the VC software world, we all speak bookings, billings, cash collections. We have sales teams that have quotas, right? Often in the space industry, I found it's not metric driven from a financial perspective. It is strategic and it's really good on the product design, but we don't have those KPIs. So we're really usually, when we're coming in as a first-time CFO, bookings, billings, cash. How much did I sell? Right? How much did I invoice my customers, and how much cash did I collect? Mm-hmm. When you look at that every week, you have an opportunity to do something about it before you look at your last month's financials. So those are really good, and it's also to me staggering. The last company, we sold a company last year was sub 100 million in value, and we were there for 2 years as a CFO before selling it. In the first 6 months, by merely focusing on days of inventory, days of receivables, and days of payables, in 6 months we put $4 million of cash back on the balance sheet, right? Because nobody ever tracked, hey, what are our, these are to us are very intuitive, fundamental concepts. But if you don't have a CFO, you don't have a great controller, often you miss this. So those are some of the keys that, to me, they're very rudimentary, but they often have a very big impact on companies.
That's great.
Yeah.
And Oscar, you kind of started out with don't run out of money.
Yes.
So I'd love to hear your perspective on those KPIs.
Very high level. How do we do that? And to your point, Sam, so we come into companies, mostly growth companies, some startups or some companies going into Reg A's or SPACs or pre-IPOs. But the middle of the road, we talk to the shareholders and the C-suite and say, how much money do you have? How much money? What's your burn rate? What's your net burn? X. How much cash or cash equivalents do we have? Well, we get different numbers, but the question is, well, we're focused on task. We have enough, but what is enough? In my previous life, I was an airline pilot. I flew for 2 global airlines across the world, and we had a rule that said 2 hours of fuel is normal, 2 hours or more. 1 hour of fuel in the airplane is critical. Half an hour of fuel in the airplane is an emergency. So we've taken some of that air transportation analogs, and I tell our clients 2 years of net burn rate in cash or cash equivalents is when you should start raising the next round. You get to 1 year in net burn rate, you better get going and starting on your fundraise. Now, if you get to 6 months or less on your net burn rate, you're in an emergency. And you are going to pay dearly for the capital. You are going to expel a lot of potential investors. And that's what I mean by don't run out of money. Put it on clear goals tables. That's the financial engineering. That's the financial planning that is challenging. It's not easy to achieve, but most of the technologists and the geniuses we work with kind of avert to that type of thinking, and they think that, well, when we need the money, we'll go for it and we'll get it. And there is a lot of room to grow in terms of the of how the space innovators and the space pioneers approach the issue of financial engineering. I can tell you examples of success in terms of a company that was mentioned here earlier, publicly traded. We started advising them when they were worth $10 million. So within 7 years, they've been market capping between $6 billion and $10 billion. And the rule that I just shared with you was applied surgically at all times. I can tell you, and that company was founded by a multi-millionaire that now is a billionaire. But I can tell you a story about another company started by a billionaire, very well known, everybody knows it, and they ran out of money, and they started asking for money when they had about 4 months of burn rate. So that billionaire lost the investment. The other millionaire became a billionaire just by keeping that rule straight. Don't run out of money. Get the financial engineering you need. Get the financial expertise you need as much as you get your engineering and technologies and scientists on board. So that's simple as it sounds. It works.
So when's the best time to ask a bank for money?
When you
don't need it.
Yeah, right.
And it's generally the same thing in connection with any type of financing that you're looking to do, whether it's debt, equity, you name it. If you don't need the money, you're in a position of strength. Even if you need the money, if you act like you don't need the money, you're probably in a slightly better situation, right? A little bit of a poker face. But there are elements that you can think about. There are things that you can do before you actually go to market to put yourself in a position of strength, or at least in a better position, less of a position of weakness, to approach the market. So I work with primarily privately owned businesses. I work with a lot of founders. I work with a lot of C-suite teams. I work with a lot of private equity funds, portfolio companies, some VC. From time to time, publicly traded companies, but usually it's in the context of a very specific M&A deal. So what am I, right? I am in sort of the bridge between the company and the financial advisory folks and the market, right? So I think sometimes people think of the lawyers and they're like, okay, well, it's just documents. We're going to create some documents. It's a large part of what we do, but it's the documents, it's the terms, it's the negotiation, it's building that. And so things that you can do to put yourself in a much better position in terms of going to market are to have all of your ducks in a row, so to speak, right? To have thought through the various KPIs that you're looking to hit, and whether or not you've hit them, missed them, having a good story around why that's the case, being able to look at a variety of crucial financial metrics to show where you are, where you've been, what the trends are, what the difficulties are, what some of the potential risk factors are for being able to build on these things. All of those are critically important, especially when you're looking to bring in more sophisticated investors. If you're looking to bring in your first institutional investor, that's a huge tipping point for a business. It's an inflection point, right? Another one would be if you're bringing in additional institutional investors in later rounds, or if you're a founder who maybe isn't ready to exit your business, but you're looking to do maybe take a few chips off the table through a recap. When the outside investors are looking to put millions of dollars behind you, they're going to kick the tires on the company. And if you don't have everything wrapped up in a shiny bow, you tend to create basically one of two different cycles. It's either going to be a virtuous circle or a vicious circle. If you've got immediate answers ready to go that show that you've thought through your process, you're a well-run company, you're a well-documented company, that there aren't a lot of surprises out there. When they ask questions and you give great responses, it builds confidence. And as a result, you're probably not going to increase the valuation of your company, but usually what happens is you start at a specific price, a specific valuation, and then through the due diligence process, legal, financial, and otherwise, that value erodes. So if you have really good answers to questions ready to go, and you can provide materials and you can provide personnel who are able to speak to whatever the questions are, you're going to protect that valuation. And so you'll also, by building that confidence in your company, you'll probably have to answer fewer questions. On the other hand, if you approach the market and you don't have all of your ducks in a row with respect to various different financial indicators, and you don't have your personnel ready to go, ready to speak to these things, to give context around the numbers that people are processing, they're going to go deeper. They're going to ask more questions that your team is probably not prepared for. And so that valuation is going to erode. In addition to that, when you're thinking about all the advisors that you may have in connection with the process, it's going to take more time. It's going to cost you more money. So the amount of money that you're spending to get that money is going to increase, right, which is going to decrease the amount that you have left as the burn rate. So by getting people involved, back to my original point, on the front end, you can do a lot to protect the valuation to actually end up with more money in your pocket at the end of a process.
So one quick comment, so I promise not to be too long-winded, but it's hard not to say something. Is our approach is that every company that's had kind of proper financial administrative, really just a professionally managed company is transaction ready at any time. So if somebody comes to your door today and knocks and says, hey, I want to give you some money, or I want to buy your company, you're already ready to go through that process. So take a due diligence checklist, compare it to the checklist of what you should have to have a professionally managed business, they're at parity, right? So these things are not nice to haves. Ultimately, you want to have these things in place because it's just good operating practices. So I wanted to add that.
So one of the things that screams at me about what you're touching on is having the exit in mind at the beginning, and exit here. That exit could be for frankly a founder company, a family-run company, a newly formed venture-backed company. Is being very crystal clear about what's the end game. Who do I want to, either if you're a family-run business, who do I want to pass it on to, which has its own sort of world of issues. But as you think about, that merger of KPIs and business financial discipline with preparing for that exit and what that funding or that next capital raise looks like, what do you find to be the biggest issues with merging those two things and telling the story to the people you're exiting to, or the people who are investing?
Well, I'll go before you actually attempt the exit. I think the one challenge we see often is shareholders dissimilar approaches towards investment horizons, risk tolerance, and exit. Mm-hmm. So one early on success or failure of the exit, in my view, is baked at the shareholders level, at the foundational stage of the entity, and it brings an interesting point I wanted to share with you. When we do due diligence in a company, it's very interesting. We ask the founders, executives, shareholders, normally privately held companies, what's your market? And they, in general, they have a pretty good grasp of what the market is, who consumes the product, services now and in the future. But there is a market, which is the capital markets, that will provide the capital that that entity needs going forward. So when we ask, now tell us about the capital markets that you're going to be tapping into or addressing for the growth of your company. What do you mean? No, we just need investors. Wait. So the ecosystem of the capital markets, those consumers with capital who have appetite to put it in an entity is complex as the market of consumers of goods and services. So we often need to make a pause and get aligned not only with the exit consensus in the shareholding group, but also to get a capital markets 101. Family office is not a private equity fund, is not a venture capital group, is not a hedge fund, is not a SPAC. That ecosystem of capital is where, Steve, you were mentioning, it requires a team of advisors that from the get-go is budgeted for, not just when you need the capital. So So capital markets as varied as consumer markets, and that's a kind of afterthought many times. But we try to bring it in to our clients early on.
And I think there's some things to match up there between what your business does, what ecosystem it operates in, being able to state, your market, if you will, from an operational perspective, and then being able to match that with the right capital. Not all capital is created equal. Not all cash is good cash. And so I think it goes back to the very beginning, right? Thinking about your exit on the way in. You want to build your business. You want to build your financial operations. You want to build your capitalization table in a way that is going to provide whatever it is that you deem to be success at the front end. And of course, as was mentioned in one of the prior discussions, right? Everybody has a plan until they have first contact with the enemy, or as Mike Tyson said, everybody's got a plan until they get punched in the face. But the planning on the front end is still invaluable, right? Everything that you do thinking about what it is you're looking to achieve gives you grounding to be able to pivot and roll with whatever is happening. So getting back to the more specific in terms of the financial markets, I think a lot of companies in the space ecosystem obviously look at themselves as sort of venture capital based. And venture capital, along with government money, is a lot of the way that the ecosystem is getting financed. And so the VC market is fairly mature in a lot of respects right now. So, VC funding dropped quite a bit over the last couple of years. It's starting to tick back up a little bit. But 2021, if you go back and you look at it 10 years back, 2021 was an aberration. There was just a lot of activity going on then. But the capital markets are never static. They continue to evolve. They're very creative. And so I think that a lot of people are stuck in a venture capital mindset. And it's good to know that, to know it well, but there are also a variety of other different types of capital that are out there. And because of the nature of a lot of businesses in the space community that have to invest a fair amount in R&D, that have long product cycles, we talked about the length basically to get from start to finish in terms of whatever the project is that you're working on. That sometimes requires more patient capital. And so family offices, if you can find the right ones that have knowledge in the space, if you can work through folks, finders, et cetera, to be able to find that capital, that could potentially be a really good fit for your business. And oftentimes, it won't be in a way that may perhaps give up as much of your cap table as you might otherwise find in a VC space. Then again, they also like to co-invest with VCs, so it sort of brings you right back to the same place. Private equity has a different time frame, a different mindset. They're putting fewer dollars out there, or probably more dollars, but in fewer companies, unlike the VC model where it's basically spreading your chips across the table, finding the ones that are successful, and then just doubling and tripling down on those in order to cover all of your other bets. It's a different mindset, and so that mindset will absolutely affect the way that they interact with your business from a strategic perspective. And so I think it's important to be mindful of those things on the front end, and then when the rubber hits the road in terms of negotiating your contracts, to be sure that you work through those items in the documentation so that you're not figuring it out on the back end. You have a game plan on the front end.
Great. So I'll say, to try to be more specific in responding to your topic, in space and defense, what's also been, again, kind of eye-opening and unique for me is every company that we've helped scale and then ultimately sold did not start off with a path to liquidity in mind. It was, we're really smart, we found something unique, we have relationships in this industry, and we're going to go grow this company, which is great. But then when we have come in, whether it's me or one of my partners, every conversation has been each conversation has been different, but very similar in this, that, hey, we're doing well, we're growing, we're starting to feel like it's getting a little bit bigger than we want to manage. It's also probably really valuable. So we say, well, hey, what valuation and what's your goal from a liquidity standpoint? And often it's kind of, well, I don't know, maybe if I could make 10 million or X number of millions of dollars. So once we get through that conversation, like, well, how are we going to get here? Because I used the term earlier, a path to liquidity, which is not necessarily an exit, right? So we have kind of a half-hour dissertation on what are the different options in capital formation strategy and what are the options for liquidity for early and subsequent shareholders through that whole path. So I won't go into that. If you want to hear more about it, I'll talk to you later. But again, I think what people don't understand is if I take some money today at a small valuation, and what's unique about the early stage in our industry here is you can build value without EBITDA and revenue, right? We all know, especially in launch and other long long-term capital intensive business models, you can grow your valuation without getting any new customers. So that's also very unique. However, where I was correlating that to is there are often opportunities for liquidity in each round, right? So you can be a founder, go raise some VC money, don't take any chips on the table. 2 years later, you can go sell 30% of your business and maybe sell 20% of your original stock. Those are things that aren't familiar to capital markets experts, starting with where Oscar started with this, that there are lots of other options. It's not just IPO or sale to a strategic. There's a lot of ways to generate liquidity for your shareholders across that whole time, right?
A question on to that. We talked in sort of a preparatory session about sort of product model. And I like to also talk about business models. You know, it was touched on earlier today, you know, product versus service versus solution versus project-based businesses. How have you found having conversations, whether you're an owner or you're advising an owner, about which way to go, where to steer relative to value creation, where to stay away? You know, is it product? Is it recurring revenue services? Is it reoccurring? Is it project-based? What's your experience around helping companies figure out which way to go?
Sure. So
all three of you can answer that.
Sure. So I'll start. So kind of what I mentioned in these two topics. So the working capital requirements around a service business and a product business are profoundly different. So as a result, scaling that business can have a very different, those two types of business can have a very different capital formation strategy, right? And so that's really where we start because, as I mentioned, we really just in the last 9 months started working with a lot of engineering services companies that are now pivoting to becoming product companies. And so when you look at the working capital nuances between those two business models, again, now I'm going to repeat what I said earlier, then it's, well, what's our customer, focus? Is it national security? Well, if it's national security, you can expect big deposits, right? If you get on the right contract vehicles. If it's commercial, you're not. Right? So you're going to have to fund all of that, either product build or engineering services, before you collect it from your customer. So I'm trying to dumb it down. Hopefully it makes sense, right? You're going to pay your employees, you're going to pay your suppliers before you get $1 from a commercial customer, but from the government, you're not. You're not going to fund that working capital.
Right?
Yeah. So value creation, I divide there's two values a company can deliver. One is value to the market, whomever has the demand for the product or service, whether it's an intangible demand, national security, a government need, or a real demand for somebody who is getting more value, more out of the product or service than the money they pay. That's the market value. That's easy to understand. There is a value creation for the entity itself, for the company. What's the value of Apple? What's the value of SpaceX? Well, is the brand, is the IP, is the team, the cohesiveness, the culture, and the capability. The value in the company, in my view, talking about people and leadership and culture, is what is that team that works together under that brand capable of? That's where we identify value in companies we look at. Why? Because when that punch comes in the face of your current demand or product or service, all you have left is a capability of a group of people that can swing and can actually roll with the punches and not dismantle or not throw in the towel. So there is extrinsic value for the market. Your product or service is more than what is paid for. But the value we look at when investing is what is that core group of people that are assembled under that brand capable of today, great product at a profit, but how about tomorrow? Will they be able to shift and swing and zigzag around the uncertainties of the world? For the space industry, that's more true than, for instance, aviation, where a much more mature industry, airlines, airports, we work with the supply chain, tier 1 through 7. That's easier to understand. But when you come to something as uncertain and unpredictable as space, we look at what is that thing capable of? You'll remember through COVID, companies like Virgin Galactic built respirators and ventilators, right? So you saw an engineering team there shifting into more than they built to a standard that is incredible. But that tells you that there is an engineering, scientific culture that is capable of swinging around. We value that very much because nothing is static, especially in the space industry. The swings are massive.
So by and large, I'd say the question is more of an internal one that my practice doesn't really focus on, internal to the companies. But I'll take it in a slightly different direction, which is sort of also harkening back to the flexibility aspect, or having a flexible mindset as it comes to running the business while still trying to achieve your long-term plans and goals. So as you see opportunities arise where perhaps you're building a product, but in the context of building your product, you see like a potential service need out there, or vice versa, you're building a service, but there's no product on the market that's directly, that ties directly to what it is you need to deliver. So you may need to go out and build one or source one. Being flexible in that way, be open to opportunities with other parties. So, for example, this is an industry where partnerships, joint ventures are fairly common. They get built, they get put together, they get taken apart. That can be, when done correctly, it's a process. You should probably think about it a little bit like an M&A deal. It basically is one. But one that is not only, you're not only putting it together on the front end, you're also trying to think about your exit on the front end. You're also building it to be taken apart at a later date. And so also this sort of dovetails, I think, pretty well with like the long time cycles in terms of pretty much every aspect of the business, even though they are shrinking. If you are trying to get to revenue, if you are trying to generate cash, if you're trying to increase your cash flows, there may be something. So one example I can think of right off the bat specific to the industry is folks that are working on modular nuclear reactors, or even working on fusion reactors. This is something where the application in space is there, right? You can see how this can be immediately useful, but in a lot of respects, it is still the future, especially on the fusion side, obviously. But at the same point in time, if you're looking to generate revenue now, there are still extreme environments, terrestrial extreme environments, where folks need this stuff. And so even if you don't want to focus your company on it directly, there are ways to compartmentalize liability. Back to one of the other examples we were talking about earlier, where somebody, it wasn't a launch company, went into launch, messed up the launch. Now the liability is potentially jeopardizing the company. There are ways from a corporate structuring perspective where you can try to create compartmentalization within that organizational structure to protect the overall company. Or potentially you can reach out to a party that's in that adjacent space where you can partner with them through a joint venture, whether it's contractual or as a separate entity, to build value there, to build your IP, and to basically help advance whatever it is that your long-term goal is. So while getting from point A to point Z may be a straight line, it may be a zigzag in terms of what you're building in the interim, whilst potentially not only working towards your long-term goal, but maybe even generating revenue on these side projects that are still, if you will, part of the long-term arc of where you want to get.
Yeah, I mean, there's I've often subscribed to the view that as long as you're clear about a destination, there are multiple ways of getting there. Some of them will make more money than others. Some will be harder than others. But just having a team of people, which I want to come back to the thing that you guys started off with early on, which is having a team of advisors. And I know, Steve, one particular thing that we talked about before the event was IP is a thing that you really feel strongly about. But on the and let's talk about that. But on the team of advisors, what do you look for in finding the right people to do this? I like hands in because they're assertive, they're tactile. But would love to hear what you guys think about that advisor team, because a lot of these companies, whether they're here today or not, are dying to find out who those people are.
I couldn't agree more with you as it relates to that. To me, you don't want to work with a team that has a mindset, oh, that's not my job, that's not my area of expertise, right? Like that's basically just a no, right? You're hiring them because you're looking for their advice and counsel. At least to me, that's the way that it should be. Regardless, again, of lawyers, accountants, financial folks, investment bankers. You're looking for answers. You're looking for solutions, and that's what you're paying them for. So, if the person, if you're reaching out to somebody and they say, let me ask you some questions, let me dig deeper here, and then they start directing you to the right places, or they start providing answers, that's exactly what you want. You want somebody to invest in your business, meaning You want them to be engaged and to take ownership over the success or the failure of the project. I think we've all encountered folks that will say, that's not really within the scope or whatever. And sometimes those are technically right answers, but it's all about the way that folks approach it, the way that they deliver that response.
Right.
Is it a no or is it a
no, but I know.
Exactly.
Right. Sam, anything?
I think when looking for outside advisors, it's really important to be able to decipher: are you looking for strategy or tactical help? Often you'll find a strategic leader that does tactical work, but the inverse isn't always true, right? And so I think. So I am in the over 25 years of experience club, like you mentioned this morning.
Right.
In the mid-90s.
Great club, by the way.
Yeah, well, I'm actually the over 30-year club, but I like your 25 plus. But when I got out of grad school in the mid-90s here in Colorado, and I was lucky to kind of land in the high-growth telecom services world. And you couldn't go get a part-time outsourced marketing person. There was no kind of fractional professional models. And now in almost every aspect of business leadership, you don't have to hire a full-time employee. And I'm not advocating for my company or my service, but it has kind of evolved into a new era of whether it's legal, whether it's strategy, finance, et cetera, that you can get good outside resources that are part-time. They scale up and down as you need them. But what I always encourage people is really understand and try to decipher, is this a tactical person or is this a strategic person? And which of these do I need?
It's great.
Agreed. And then no more comments on that. You said it very well. But here's the challenge we find. So we convince the companies, clients, we need a team. And the team is a legal advisor, a tax advisor, a CFO, CF engineering, whatever it is, and say, agreed, let's do it. So they ask us, so who do we find? I say, we're going to find the best people, we're going to pay them well, and it's going to be cheap. And they say, okay, they get that too. And then we go to their budgets. So how much have you budgeted for this? What? Budget for a team of advisors to get us ahead in the finance, fundraising, capital markets. I don't know how many of you have seen startup business plans or even early stage business plans. Two big mistakes we see. One, cost to capture clients is always way underestimated. Time and money that it takes to get a new client. But the budgeting, second largest error is there is no budget for a team we're talking about here. More and more, I think we're getting more inroads, but more than 10 years ago, say. But still, there is a resistance to launch a business or to grow a venture with the proper budgeting for the policy, regulations, standards, and financial compliance, if you will. So, simple as it sounds, a budget for what we are discussing here is one of the biggest Achilles heels. And we've seen companies have problems because when they needed the team, there was no budget. So now we needed to raise money to secure a budget that was never considered, and then it gets very, very
starts to spiral. Right.
Speaking of which, I would also just say that I think it's important when you're building out that team to ensure both with respect to your internal folks and the external advisors you're engaging. Communication is critical, right? Very few people are good at mind reading, and a lot of people, quite frankly, are just not terribly good at communication. And so as a result, you want to work with people that are going to be cross-collaborative, right? People that are going to be constantly asking questions, answering, looping people in to ensure that the left hand knows what the right hand is doing. If you're working with somebody who isn't used to engaging in that way, you're probably going to get frustrated, but in addition to that, you're probably going to end up driving up fees because people will be working on stuff without knowledge of what somebody else, one of your other advisors, is doing, and you just end up wasting time and money.
I mean, from my own personal view, I tend to over-communicate because I want people to know, and I have always looked for that from other people, because communication is like, I think, cash is the blood of a company. Communication is what's kind of greases the skids to make it all work. So I think you're spot on with some of that. I'm going to turn to the audience for questions. We've got about 10 minutes on this, so fire away if you have one. Lee.
Oscar, how did you arrive at the 2 years of cash number, and how did you balancing you're slowing down growth to make sure you have 2 years versus being more aggressive? And what do the other panelists think about that number?
Thank you. The 2 years, 1 year, half a year is not an exact number, but there should be a comfortable, critical, and emergency. And it's around those figures. But is the culture and the modus operandi of the shareholders of the companies. They need to be ahead to an extent, depending on the burn rates and the moment of the company. But there has to be a trigger where if the fundraising happens before it's needed. And that's so hard to do because we're so mission-focused, task-focused that to convince smaller companies in particular to get to that stage early. So it is more of a comfort, critical, emergency, if you will. But it's not too far from those figures. It's not an exact figure, but that's those 2-1-6 months is something we like very much in my firm.
I would certainly look to the outside advisors as to what the right numbers are in terms of having that conversation. But I would frame it, naturally being a lawyer, right? I would frame it in terms of risk tolerance and sort of bringing that back to the management team within the company. So as you're having that conversation and trying to arrive at the numbers, right, in terms of the amount of money and the length of time to be able to get the to the next financing round or whatever it is you need, the next injection of equity or debt or whatever the case may be. How much risk are you willing to take on? How much are you willing to jeopardize your business? And what does that look like in a material fashion, right? When we're talking about risk, does it mean that you're going to get a lower valuation? Does it mean that you're going to go bankrupt? Does it mean that, what exactly does that mean? Does it mean you're going to have to drop a product line or put that on the back burner while you're focusing on something else because your cash burn situation's out of control? So that's the way I would look at it.
I would say it's a nuanced answer, right? Depends on what stage you are. So if you have existing venture capital investors or private equity investors and the company's performing well, you would expect them to be willing to participate in another round of funding, which if they'll lead it and they've got a strong brand, typically will attract other partners to syndicate that round with. But I do like 2 years. In the tech world in the 90s, when capital was very accessible and lots of, it's kind of always been in that state. We said 12 months minimum, right? Because I always tell people, if it's your first round of financing, you should plan for 9 to 12 months to get it done, right? If you're starting from scratch. If it's a second round of financing, 6 to 9 months, depending on whether you're going to get sponsorship from your existing cap table, right? So, and then you've also got the moving parts of, well, how much cash are we really going to need, right? Because it also depends on if you're pre-revenue, you're just controlling expenses. It's really easy to control expenses, right? But if you are a company that's generating revenue, it's very hard in the space industry to predict sales cycles, right? And P-win rates. So if you're planning on having a significant source of cash coming from winning new business, then you have to look, are these continuations of existing programs? Are these new programs? So it's a very nuanced answer, but I like 2 years. I think 2 years for pre-revenue, maybe as short as 12 to 18 months if you're a company with revenues, but still burning a lot of cash.
One additional note, just anecdotal as well, but having some of the numbers are starting to come out for the 2024 year in terms of like venture capital, et cetera. And the amount of time between fundraising rounds is lengthening right now as well. So that's something to factor in.
Other questions?
Not really a question, but a comment to add to this is I also think there's a very strong human element to this.
Sure.
Because you talk about, I have been as a leader, the CEO of a company where, well, I'll just say we weren't in the comfortable zone. And people start to talk, no matter how confidential you keep the information, people start to talk. And as we're going to get into the next, panel afterwards on how to keep your employees, it's something where it has a huge human impact. So I just wanted to add that component to it.
It's a great point. And, a lot of folks will utilize equity as a means of incentivizing folks. It does a great job in many respects if used properly to align incentives. It can also be a great way to make the cash that you do have on hand go further. But you've got to be very, very careful and intentional with how you do that. And to the extent that you put yourself in a danger zone, the value of that equity and whether or not there's any value there at all obviously begins to potentially diminish or diminish in the eyes of the employees that you're trying to keep. And so regardless of whether or not there's merit there, right? Once rumors start to fly, you can find yourself in a situation where it may become more and more difficult, more and more expensive for you to be able to retain that talent. So it's certainly a factor to consider.
Yeah, and I'd like to add to your comment. So, a question: has anybody worked for a company that's run out of money and had to shut its doors down? Don't be afraid to say. Okay, maybe not that many. I have. I worked for 4 companies in the go-go days of the 90s and early 2000s that raised A and B or A rounds and ran out of money 18 months later. It is a horrible experience. But what I learned from a mentor in those years that I didn't listen to is, well, I wasn't the CFO. I was the number 2 finance person. But that no company has ever gone out of business because it raised too much money.
Right.
Yes.
Right. So when I go back to what I said, the capital formation dance, right? You want to build as much value so that you can take less dilution, but you don't want to run out of money. So it is not an exact science. 2 years is not a perfect number. You said that, but working for a company that has a clear sight line to potentially or a high level of certainty of running out of cash is not a pleasant experience.
Yeah, cost control and capital formation should be baked into the DNA of any company. Much more startup in the space industry, but it's the budgeting for the capital formation. Yeah, it's late and sometimes inadequate.
Yeah. And I have to say it was somewhat cathartic. I don't think I've ever publicly admitted to a group of strangers I've worked for more than one company. Ran out of money.
It's a safe zone. It's a safe zone here.
But this is the nature, and you mentioned it, of early stage investors will tell you, right? If I used to work for seed and A round companies, right? If you make those bets as a VC, you're going to have 20 to 30% of them. You're not going to return any money. I didn't realize that as an employee and a risk-taking young man, but. Yeah, it was. It was. But again, this is, I think, again, when you talk about what type of advisors to bring in, it's not just CFOs, it's not just bankers, it's a collective group of advisors that can help you. Because this capital formation strategy, you can have the world's best team, the world's best business plan and products and customers, but you have to nail this down. And this is very esoteric and typically not something that every founder has experience with.
Right.
I do think there's a balance to that, though. One last point that I'll make as it relates to that is that I think that there is a certain mindset, in particular on one coast in one city, where sometimes the financing piece gets placed in front of the business. And I think the way that I see finance, and maybe I'm just a dinosaur at this point, but the way that I see it is it's a crucially important foundational aspect of your business, right? Your business is not going to be successful if you don't have your finances, tight and managed well. But at the same point in time, if you run your business strictly based on financial performance without keeping in mind your customers, your employees, everything else, if you just focus like a laser on that, I also think that you're probably going to run your business into the ground. Maybe long-term in the future, right? But you're going to hit a point where you're at the very least going to miss out on building a much more lasting business that's going to be successful for the long term.
That's a great, perfect segue, Steve. You're awesome because that leads us right into the human side of things that was mentioned a second ago. So thank you guys for doing this. We're going to move on to the workforce panel with Deborah. Thank you guys.
Thank you, John.
Yeah, it's mic off. Yeah, the mic is off.